In the last few days, there has been a massive global tech sell-off as well as the Japanese yen appreciating. And you guys have asked me to make a video on why I think, for instance, AMD stock has gone from in a month $180 to $130. Nvidia stock has dropped off as well as Intel crashing to some very new lows that we haven't seen in a very long time. And also, speaking of AMD, we have their new Ryzen 5 9600X review coming out tomorrow, so do stay tuned for that one. But this one all comes back to banks and what banks do. And here's where I'm going to read you a passage from The Creature from Jekyll Island. Very, very good book, well written, and it explains a lot on what goes on in the world and especially events like this before they even happen. So we're just going to quickly go here to the Q&A section where they ask, question, what are the banks for? Answer, to make money. And the next question is, for the customers? And the answer is no, for the banks. And that right there should tell you all you need to know about banks in this world. They have a massive amount of reserves on hand. And in particular, this example I'm going to pull up is the Bank of Japan. In Japan, they're responsible for issuing new currency. They're responsible for issuing the interest rates that are available on demand for money in Japan, as well as another job that they do is currency manipulation, aka controlling the strength of the Japanese yen, as they would put it. Though what we saw from the Bank of Japan before these tech stocks sold off, as well as the Japanese yen appreciated, was that we saw that the Japanese yen was being bought up by the Bank of Japan and in quite a large sum. Now, they say the goal here was to defend the Japanese yen, and that, of course, is a legitimate excuse. However, there is a big ulterior motive here for the Bank of Japan, and that is to make money. You see, the Bank of Japan isn't a non-for-profit bank. In fact, they churn out a profit just like any other massive global investment bank in the world. However, they do it in a more open fashion, and they're telling you what they're doing. And in this case, they're manipulating currency, and they're doing it not just in the form of buying the yen when it's extremely cheap, but they're also the issuer of the currency, as we said before, and they control interest rates in Japan. Now, this is a very big point, this last point that I talked about with controlling interest rates, because when you raise the interest rates in a country, you're effectively controlling the liquidity conditions that exist for people who, say, want to borrow Japanese yen and then buy other currencies like the US dollar or the Australian dollar, aka the carry trade. Though this is one thing I haven't seen anyone really talking about, and that is the same bank that's manipulating the currency is also manipulating the market conditions for the value of that currency. And so this, ladies and gentlemen, is a huge conflict of interest, the likes of if you or I to do anything like this in a market, we would probably be thrown in jail. Now let's talk about this more in depth right after today's video sponsor. If you want to get rid of this annoying activate Windows message, then today's video sponsor SCD Keys has you covered for as little as $15 US. After you enter that coupon code BFTYC, you can cop yourself a legit single end user license today. Also works for Windows 11 Pro too. Links in description below. Welcome back to Tech Yes City. And what we saw with the Australian dollar was it appreciated to the likes of 109 yen. I actually haven't seen these levels, I believe, since before the GFC. And now this is a very important note because the last time I also saw such a rapid drop in the Australian dollar was pretty much during the GFC. And so what market conditions prevailed in the GFC was that the average person was going way in their head in debt. And they were doing so via a mechanism known as derivatives. And you just got to follow me here because this is all tying in perfectly with the outcome and what I think is going to happen. And actually, in recent parts hunts, live streams, I've been telling you guys that I think something like this and something like this will continue to happen all throughout this year and possibly into the next year. The tightening of financial conditions as well as the average person, especially the average person who's borrowed up beyond their means, losing a lot of money. And essentially that said person could become bankrupt. Though disclaimer, this isn't financial advice. You may wish to look at your position now, because I can tell you from personal experience, sometimes you're looking at a loss and then things just get worse and they keep getting worse to the point where you get margin called and you can lose the lot. Now, in terms of providing an example about this, I like to read ahead if I can in the midterm. I like to try and look forward into the future around 6 to 12 months, especially when it comes to financial conditions, because I do sell gaming PCs here at Tech Yes City, and you might laugh. You're like, Brian, gaming PCs are nothing compared to global stocks and global carry trades like the Japanese yen versus the US dollar. And yes, you may be right, but I enjoy these things. And for me, it's much more certain and I have control over what I feel is going to happen and how much profit I can make. And so essentially in late 2022, for example, I made a behind the scenes vlog telling everyone that I was selling a lot of my PC parts very quickly at slightly lowered prices than the market because I thought 2023 was going to be quite a bad year. And indeed that did come to fruition. And so that was me cutting my essentially losses. I could have, sure, sold a few more PCs at a higher price and made a bit more profit, but that was me sort of taking a preemptive loss on that potential profit and selling a lot more so that overall I'd be in a better position. So one thing you have to do as an individual, and I care about you guys, the people who tune into Tech Yes City, especially the subscribers, everyone who watches the content, I care about you guys. What you've got to look at is the position you're in now versus the position you could be in 6 to 12 months time. And what I feel with these market conditions and what's unraveling here is conditions that are similar to the GFC, at least with this massive shock that I believe is going to come, followed by, of course, a massive amount of money printing. But when the money printing starts, we can then reverse course and change things and keep you guys updated on what I feel will happen going forward. Though taking a trip back to 2008, here is a year where the banks, and this is mainly the reason for the GFC, was the banks were lending money to people that they shouldn't have been lending money to. And this wasn't just real estate, it was also in the form of other things like carry trades with margin loans, for example, that were going as high as, say, 50 to 1. I even saw some brokers allowing you to borrow at 100 to 1 ratio. So what that means is for every dollar you have in the account, you can borrow $100 on that position. Now, if things go your way, you can make a lot of money. Your potential profits can be 100x what they would be if you were just to use your balance and the money that you actually have in your bank account. But when things go against you, and here's the problem, and this is the problem with this whole market right now and the derivatives market, is when things go against you, that money can turn into a massive loss very quickly, very fast. And if the broker themselves cannot cash out your position in the market quickly enough, then they can also lose money too, sparking a financial contagion. So you can see where we're going with this. So basically, in a nutshell, derivatives, aka Fugazi money, I love that term. That was the reason for the GFC in essence. And also it's the reason why things are happening as the way they are now. Because what we're seeing here with these tech stocks going, for instance, let's take AMD for example, going from $180 down to $130 in the matter of a month. This is almost like what you would see with a penny stock, except AMD is no penny stock. They're a massive corporation in the world that makes very good products, and same with Nvidia going from $130 down to $100. And we've seen Intel just crash down as well, massive amounts, but Intel on the other side of the fence has a lot of problems going on internally, which we could talk about in a separate video about what is going on with Intel as a company, but we've already spoken about this actually quite numerously here on the channel. So Intel's in a different position as opposed to AMD and Nvidia, especially Nvidia, which seems to be doing extremely well right now. So then, what is going on here? Why are these stocks prices going down? Well, you see, a lot of people have margin loans on buying things like Nvidia stock or AMD stock. And when the prices start to come down a bit, a lot of these big banks, investment banks or big hedge funds, for instance, they start saying to themselves, well, we better cash out these positions before we potentially lose money. Now, with a hedge fund, and I have a friend who works at a hedge fund, they tell me risky at a hedge fund is a 4-to-1 margin ratio. In other words, for every dollar that a hedge fund has in an account, they like to borrow around $4. Now, the safe hedge fund play is a 2-to-1 strategy. And if you go anything over 8-to-1 in the hedge fund world, you are considered insane. So if you're an average mom and dad investor like me, I would not recommend touching margins above 2-to-1. That is just my advice, and I've always said this to people in the past. Don't go anything above 4-to-1. Again, these are the people who actually make a lot of money in the industry. You should follow what they do rather than trying to book up, say, a 20-to-1 loan on the US dollar versus the Japanese yen. Now, speaking of that, this is the next problem that happens here. We've got the Japanese yen appreciating rapidly and quite fast. Now, some would say, well, the Japanese yen is causing these stocks to sell off. And this couldn't be further from the truth, in my opinion. We don't see the average person calling up their friends or the average mom and dad calling up their list of relatives and going, hey guys, we got to sell our carry trade on the US dollar and start buying the Japanese yen back. No one does that. Like, I haven't heard any one of my friends know even what a carry trade is, let alone how to do it and how to buy Japanese yen or US dollars or Australian dollars. They don't know these things. These are instruments that are left usually to the very wealthy. And the very wealthy in this case do like to borrow Japanese yen and buy Australian dollars. And how they do so is via FX brokers. And these FX brokers, whether they're retail brokers or they're actual market makers themselves, will then charge a pip differential in the market, and that is their profit for doing so. However, that said, when you go back to the Bank of Japan and they start raising the interest rates, they're essentially saying to the market, we are tightening financial conditions, so your broker may therefore stop lending you as much money going forward, and they may even change their margin ratios and the max ratios that are possible on their platform, meaning that if they were previously offering, say, 20-to-1, they could then change that to 10-to-1 or 5-to-1 and say, hey guys, we're just sort of buckling up here for a uncertain future, and so we need to lower our margin requirements. And so when that happens, you can see now the financial conditions on the Fugazi money, the derivatives market, starts to tighten, and also banks are then less reluctant to also give out margin loans on things like buying stocks, as well as give out margin loans in the general economy to people who are, say, buying real estate, or they're buying things that they need for their businesses. And so there's less money in society that's being created and going around. Hence why the Japanese yen is appreciating, because it's generally the currency that people borrow for this Fugazi money in the world markets, because it's so cheap, because they have historically had very low interest rates. And so when you get those low interest rates and then you invest them in, say, American dollars, or you invest them in Australian dollars with higher interest rates, and you do it at a ratio of, say, 4-to-1, you're then making 4 times the profit. Or in this case, if you're buying US dollars 4-to-1, you're making around 20% year over year. And that's considered a little bit risky, but 20% profits for doing nothing, just for holding cash on Fugazi money, that is an extremely lucrative offer that the brokers are putting on the table, one which a lot of people do take up. The one thing that the mum and pop or the average person is doing, and this is the last part of talking about why the Japanese yen has been appreciating, is that the average person is buying Japanese yen a lot. They're converting their Australian dollars or their US dollars, which are overvalued versus the yen, and they're buying the Japanese yen to come here on a trip, or they're doing so to, say, buy a car over here and then try and bring it back to their respective country. And so this creates upward pressure for the Japanese yen. And I think a lot of people, myself included, are in this last category. A lot of us have either been thinking of coming to Japan for a trip, or of course we have already been buying up Japanese yen because of how attractive it is. And I've been saying this for a while. I think the Japanese yen is extremely undervalued versus at least the country that I'm very familiar with, Australia. So of course that means historically high demand for the Japanese yen. Now apparently the number 2 export is tourism. It's that big. So it's making definitely a huge impact if we look at GDP and we look at trillions of dollars. And this is what it takes to move currency markets. Tourism is now, of course, starting to definitely make up a big impact on Japan's currency. Because if we look at what the mum and pop dad investor can do, and that is when they all collaborate on something, they can raise the value of that. And a classical example, if you guys may or may not know, was GameStop actually. When the mum and pop dad investor gets together and they start rallying for a particular asset, it can go up tremendously fast in a very short time frame. And that's exactly what happened with GameStop. But what we saw with GameStop was because the average person wasn't part of an investment bank or they weren't an elite investor, they definitely shut that one off and manipulated that one. And they did it to the likes that I've never seen before in the stock market, which essentially is why I personally do like to stay away from stocks. But I do like to endeavor in the world of FX with my small little safe positions that I have a lot of fun with. The last part of this video is then relating what's happened with the Japanese yen back to the global tech sell-off. And this is where there really isn't a huge relation here, more so just a correlation. And that is what's happening is the Japanese yen is appreciating at the same time financial conditions are starting to get worse in terms of liquidity. And that is margin loans that are being loaned out are starting to tighten. Banks, and we've seen this in the US and Australia, they're definitely lending out less money than they were 1 or especially 2 years ago. So these conditions have been in play for a while. It's just that it takes, I guess, a little while for these things to break. And usually when they break very fast and very quickly. And that's, of course, as we spoke about with that financial contagion early in the video, when things start to go bad, it's like this domino effect and the house of cards essentially falls over and there are less bids on the market for whether it's stocks or bidding up the Japanese yen, but these bids start becoming less and less. So there's now less buyers of the said asset and the prices start to drop because there's more sellers, people who are cashing out as quickly as possible to try and take a profit now, or whether it's they're getting forced, and that's called a margin call, where they are actually forced to close out their position because they simply have lost too much money and they don't have any more money to cover their balance. And essentially the broker then makes the forced decision to cash out that position. And if there isn't any more bids left to fill the order at that said price, they can then lose more money and the broker themselves can go bankrupt, and that can then start an even bigger effect on the whole market. So it is important to know the risks that exist in these markets. And it is, of course, important to watch going forward interest rates, but also related to interest rates, the banks and their ability to loan out the Fugazi money, aka the derivatives market. Though one thing I will close out this video saying is that no one knows exactly what is going to happen in the future, especially guys like you and me, because we don't control anything in the grand scheme of things in this massive market, like for instance, the Bank of Japan, which is creating open conflict of interest. So if you were to know what the Bank of Japan was going to do ahead of time, then you could know exactly what is going to happen, if that makes any sense. But going forward for you guys, closing out today's video, the best piece of advice I can give you going forward, I don't know what the Bank of Japan is going to do. I don't know what the Federal Reserve is going to do. I don't know what the Reserve Bank of Australia is going to do. But one thing I do know is value at Tech Yes City. Value. I know the price of something and what it's worth. And if something's cheap, buy it. And that relates to tech perfectly, right? This whole channel has really been built up off of tech deals, value, getting those used bargains because those things are undervalued. Now, the yen, of course, the yen, even at its current price after this rapid appreciation of it, I think it's still very undervalued. And so I think it's still got ways to go. When something's undervalued, you buy it. When something's overvalued, you sell it. And that's the best advice I can give you. Don't look at it any deeper than that. Try not to look at it any deeper than that, even though today we definitely looked at it a lot deeper. But it always comes back down to what you know is going to happen in the future. And what you should know is that things that are extremely undervalued generally appreciate, and things that are overvalued generally depreciate. And that's just the best generalization and the best advice I can give you guys coming out of today's video. Anyhow, with all that aside, I'll see you in the next one. Peace out for now. Bye.